Hi, I'm Jarrad Brown, Australian expat financial planner based here in Singapore, and welcome to my video series where we tackle the tough personal finance questions for Aussies abroad. Today we're here to talk about the age-old question, should I invest my money in property or should I buy shares? Which is the superior investment? What's going to allow me to achieve my goals faster? Should I borrow money to do it? Where should I buy these shares? This is what we're here today to talk about, so let's dive right in. Now, it's important to note first and foremost that there is no clear answer to exactly what is going to be better. But first, what can we look at? Well, we can look at the risk and return over time, and we can look at how property and how shares have performed in comparison to one another. Now, first and foremost, we've got risk and return. If we look at the last 20 years of data in Australia, the returns across both property, residential property we're talking about, and shares have been very, very similar. Property is actually slightly outperformed, but it's important to note that isn't a guarantee that that happens again. We're also in a record low interest rate environment. So that's naturally going to impact property, given that most property buyers will utilize leverage, i.e. take out a loan to buy that asset. The second part is the risk and expected return. Now, naturally as investors, if we're taking on more risk, then we want a higher return. If we're starting our own business, we might be targeting a return of 20, 30, 40% depending on the industry that we're operating in. But if we're buying shares, we might be looking at 6, 7, 8, 9%, maybe a little bit higher, and property we're targeting quite similar returns. Now, if we look specifically at the data suggests that shares are more volatile, more risky, and on a global level should outperform property over time. So we know a little bit about the data, we know a little bit about expected risk and return, but let's have a look at some of the factors that you should be thinking about if you're deciding which is going to be better for you. Now, the first one is the transparency of the investment. Now, a lot of people think that property is safer because they can go and inspect it, they can touch it, they can feel it. It's that old saying, safe as houses. If it really goes bad, you could go and live in it potentially. So it makes people feel a little bit safer. Now, just because you can go and touch an asset doesn't mean that you know what anyone's prepared to buy it for or what you could sell it for in the future. So it's very important to just bear in mind that transparency is not everything. Now, if you compare that to investing in shares, let's just say we bought shares in BHP, it's very unlikely we're going to go and look at the smokestacks or one of their mines. That's just not how share investing typically works. So transparency, property is often seen to be the better option. The second key difference is the size of the market itself. Now, if we specifically look at Aussie shares and Aussie property, the residential property market is on average about 3 times as large as the stock market is. Now, naturally, Australians have a bit of an affinity for property. We all need somewhere to live. So naturally, the property market is going to be a bit higher. And what we've seen as a result of COVID is the Australian government and the state governments have thrown an awful lot of money at new housing to encourage first home buyers, to encourage construction, and to keep our construction industry very healthy throughout this period. Now, the third one is the actual cost of the transaction itself. Now, as most of us will know, we can set up a share trading account, we can buy shares very quickly, very inexpensively. We might be looking at $5, $10, $25 a brokerage, and we own the shares if we want to sell them. Again, a very quick and cheap exercise. If we're looking to buy a property, however, we've got stamp duty, we've got agents' fees, we've got conveyancing, we've got inspection costs, we've got quantity surveyor reports, we've got a whole raft of different costs to actually get into that asset. Now, it's not to say that property is bad and shares are good, but when we're doing our comparisons, it's very important to make sure you factor in all of the costs. And even if you're looking at buying property in Singapore, and we're not going to get into this too much in today's video, we'll save that for a future video. But if you are buying property in Singapore, you also need to look at the additional buyer's stamp duty and any seller's stamp duty on exit. Make sure that you factor in all the costs and you're truly comparing apples with apples. The fourth is utilizing leverage. Now, a common practice when you're buying a property, whether it's a property to live in or an investment asset, is you'll often utilize a loan. Now, that means borrowing some money from the bank or a lender to actually fund that purchase. Commonly in Australia, you put down a deposit of 20% and you'll borrow the other 80%. Now, That's typically not a major issue for most people with Australian property, because whether or not that property goes up, down or sideways in value, as long as you make your repayments, the bank is very unlikely to bother you about any repayments just because the value fell. Now with shares, however, if you were to borrow 80% of the value of your portfolio, that is going to be a wild ride. Because if the value of the shares drop below a certain threshold, you're going to get hit with what is called a margin call, which in simple terms means that the bank or lender gives you a call and they expect more money to be in your account by 9 AM tomorrow morning. Now, imagine if we're in some sort of financial crisis or collapse, your portfolio drops 30–40%, are you going to have that additional capital to call on? So for most people, the aspect of leverage is going to be far more sensibly applied to property, non-mark-to-market assets. It's not to say it can't be applied to equities, but often it's far more sensible when we're investing in property. Now, the fifth important element when you're comparing these two assets is the actual liquidity. Now, without going into digital ownership of properties or unlisted unit trusts, if we just take a very simple purchase, we go and buy our investment property or we buy our home, it's very difficult to just sell the bathroom or sell the kitchen if we need money in future. Now, if it's shares, however, and we own a parcel of 1,000 shares in a particular company, let's just say it's in BHP to use a good Aussie example, then we can go in and we can sell 10 shares, we can sell 15 shares if we need to raise a little bit of capital. Without too much of a hassle, as I said earlier, the brokerage is very cheap, so we often have access to far easier capital. The sixth most important feature is the actual yield, so the amount of income that you can derive from your shares or your property investment. Now, depending on where the property is, most properties are going to deliver a yield of anywhere from about 2 to 4% once you factor in the costs of owning that asset. Now, that might be enough, that might be too low for what you want to achieve, but it is important to bear in mind that that would be a rough expectation. If you are looking at property, obviously check out that specific property in terms of expected rental income. If, however, we're looking at dividends paid on shares or coupons paid on bond or fixed income investments, then that might be a little bit higher often. And that might be more like 3.5% to 5.5%. Again, depending on the company, it's important to do your homework here. Then comes our final important feature, which is the actual tax implications. Now here we need to think about two forms of tax. One is capital gains tax on sale of the asset. Two is tax on any of the income that we derive. So if we're looking at rental income, again, depending on the ownership of the property, but if we just own that property in our own name, in most cases, that is going to be taxable Australian income. Whether we live in Australia or we live somewhere else, that income remains taxable. Now, naturally, we get the tax-free thresholds to think about, but in simple terms, that will be taxable income. If we're looking at income from our shares, however, i.e. in the form of dividends, then often if we're a non-resident of Australia, depending on the double tax agreement, and we're receiving fully franked dividends, then they are tax-free. Now, as I said, important to do your homework here, seek proper tax advice, but it gives us a lot more flexibility when it comes to the dividends that are actually paid. So after all of that, what is the answer? Unfortunately, it depends on your own situation. There is no one size fits all, and often it makes sense to have a combination of both when you're looking at your own wealth creation strategy. When we're working with our clients, we're considering both, certainly, when it comes to investing in property, buying shares, how should you own them, what are the pros and cons based on your own individual goals and set of circumstances. Now, that is why it is so important to seek advice here, because there are many, many things to consider. I hope you find these tips helpful. I hope it gives you at least a bit of a starting point. If you're looking at how to build your own wealth, should you buy shares, should you buy property, should you do both? And I just hope that gives you a bit of a framework for comparison. Thank you very much for tuning in. Don't forget to subscribe, and I look forward to seeing you next time.